Okay, so for those joining for the first time, my name is Kai Jun. I just finished my second year in Cost and Finance, and I keep investing for about 5 years or so through fundamental analysis lah. So I'm actually doing this to share my passion, out of passion, to hopefully inspire others to kickstart their journey as well lah. So disclaimer about myself is I'm not a financial advisor, so do take this as infotainment purposes only. If you like to kickstart your journey, do seek on consultation from your own financial advisor or do your own due diligence research lah. So today itself, we're going to talk about economics and actually how it sort of like helps in terms of shaping our investment decisions. So moving forward, one of the many reasons, we have to understand economics is due to globalizations, where economy actually dependent on one another to a certain extent or a certain degree. So economics is actually the studies of production, distribution, and consumption, which can be broken down into two broad areas, which is micro and macroeconomics. So there are other indicators which actually I shared about in the past, which is like your unemployment rate, your CPI, PPI, GDP, GNP, the trade balance, as well as interest rate. So simpler way of understanding economy would be supply and demand. So as economy is a very broad topic itself, we will actually talk about three different areas, which is the structure, indicators, as well as the business cycles. So for those, I believe most of you that is tuning in, one way or another, you all have certain understanding of economics. So bear with me a little. So the structured economy is under four different structures: perfect competition, monopolistic, oligopoly, and monopoly. These are the four main structure. So for perfect competition itself, what we're looking at is actually very similar to the bubble tea business that is where it's a price taker in this aspect in terms of their business itself. So from a global point of view, to get an example is that we can see this in the agricultural market, whereby if let's say a particular farmer in the industry would like to, increase the price of maybe let's say for 1 kg of corn to increase the price in a sense, you actually lost its profit margin because everyone is selling at the same price, which is another word for price taker . So as we go down the list, we are able to see monopoly, which is actually the only player in that particular field. So in Singapore context, is actually our PUB, whereby they are the only providers of water and utilities, in a sense, water and electricity to the household as well as the commercial and industrial and stuff like that. So next one will be indicators. Three main indicators: leading, coincident, as well as lagging. So leading indicators are actually the reflection of more of a forward-looking approach, whereby they identify through new businesses, housing market, and the stock market itself. Where for coincident indicators is more of measurement on the industry production index, manufacturing and trade sales, which is actually the reflection of the current state of the economy. As for lagging indicator, it reflects the past condition. So examples are like the interest rate, trade balance, unemployment, and the money supply. So last but not least, which is the business cycle, which is the four different stages: peak, contraction, trough, and expansion. And I'll get to that in a bit. So a good indicator of an economy is actually when we do see a consistent growth that is being observed. Recalling back to the top-down approach that we have shared on in the past, if an economy is performing well, business operating within that particular economy under the industry will tend to flourish as well. This also translates to consumer confidence to spend more, raising the overall goods and services as well. This also leads to, in other words, living standards in a particular nation. So although this is, I would say, it is actually the consumer who determines the direction or actually the driving factor of the economy. Government do still play a role in terms of their influence in the economy through both fiscal and monetary policies . So continuing from the previous slides, understanding the business cycle, or what we know as economic or trade cycle itself, is actually I would say the stages of or life cycle in what we can see in the economy. So expansion, the stage itself is actually seen after the trough, the lowest point in the cycle, before actually reaching its peak, which is the highest point in the cycle. Contraction actually, it happens after the peak when there's a deceleration in the economy activities, which is what we know as recession. In a worst case scenario, depression, if there is a severe decline in economic activities. So cycles like that happen as short as a year period or up to between 10 to 12 years. So a few, I would say the characteristics of a business cycle is that during the recovery stage, we do see a constant inflation and interest rate. Normally they are quite low in a sense. Business starts to, hire contract staff instead of a full-time worker, and they ask current employees to overtime in order to save costs, as per headcount is very expensive. So as during the late expansion itself, the later stage is where inflation and the interest do increase over time. Business starts to higher and unemployment rate start to decrease. However, at the peak itself, inflation continues to increase as interest rate rise. Hiring do slow down as too much of a labor has the opposite effect output. Has the I won't say opposite effect, but will have decreasing effect on the output itself. Contraction itself is when the bubble pops due to I would say during the cycle itself. So when the bubble pop, inflation start to slow down, interest rate may decline, hiring freeze start to happen, and we start to see layoff which is actually the lead to the rise in unemployment. So policies, like I mentioned earlier, there are mainly two, fiscal and monetary policies. Both policies have the ability to actually influence the economy to meet the supply and the demand equations. So fiscal policies generally have a greater impact comparatively, despite despite that taking a longer period to be implemented and before results are being seen. So a simple example would be, if let's say I were to compare Singapore and US, is that Singapore tends to use fiscal policy, whereas for US tends to use monetary policy. One of the few reasons is because of our government and how our country is being run. For US, as we know, their election takes place every 4 years or so. They would like to see, I would say, changes or impacts in a short-term period. Whereas for Singapore, we do have a stable government and a government that runs on a longer term or longer period. And because of that, they do, I would say, are able to implement fiscal policy which take up a longer duration in order for certain effects to take place. That's why you see in the US, the Fed start to print money and stuff, whereas for Singapore, our government will steps in to implement certain spending like subsidies and stuff like that. So understanding the market in the economy itself, I think there's 4 main market that I want to talk about. Factor market, which is actually anything that is used to finish a particular product. So example is like the capital, labor, raw materials, or even the land space itself to construct industrial or like residential estates. So goods market is where companies and household interacts. So in other words, a transaction would actually a transaction in a sense that will actually take place. Labor market, which is actually the availability of employment in terms of supply and demand of labor. So in a sense that it means your workforce. Capital market is actually the financial system to raise the capital, dealing with shares, bonds, and long-term investment, and what we known as the stock exchange. Similar to industry, there's actually sunrise and sunset industry. So likewise for economy itself, there's these two, emerging and developed country itself. So for developed nations, we tend to see advanced economies, better developed infrastructure, mature capital market, as well as a high standard of living. So we are actually able to see, to a certain extent, stability in the political scene and the regulatory bodies. For emerging countries itself, we tend to see, infrastructure undergoing construction, slight social and political instability with a low standard of living itself. So needless to say, one has a stable growth, whereas the other, if overseas and managed well by the government and relevant authorities, will be enjoying rapid growth followed by success of building a great nation. So in a sense that from investing, it's also important to identify which economy or which kind of country you're investing into, and both of them pose respective risks. Doesn't mean a developed country doesn't pose any risk. Actually, they do pose a fair share amount. So it's also important to identify what kind of risk you're willing to take as well. So for example, as an emerging market, it might actually hold maybe a different kind of risk due to the stability aspect. However, we need to understand as well that investment is a form of risk management more than another. So to sum it all up, in a sense, using what I have actually shared earlier, we are able to actually identify a few trends this year, year 2020 itself. So under the business cycle and central bank, which may shift to a neutral perspective, is that governments globally are actually introducing policies to cushion the impact of the current pandemic, helping economy to actually, I would say, slowly get back on their feet. However, we are still in the process of trying to get up from the fall. Unemployment itself is increasing and business actually defaulting, I would say to a certain extent, it's not yet a clear sign of any form of recovery at the moment, but we're still working on it. So with a monetary policy running out of steam in the US itself, we start to see the government there implementing fiscal policy at this current moment. Fed is also setting interest rate at 0.25% to spur the economy, and FOMC is actually expecting a target of inflation at 2% itself. So next, we have the tech situation where everyone is hype up about the tech companies, due to their acceleration in adoption of digitalization. So the next question, I think as an investor, we need to ask ourselves is the valuation sound? Does it make sense to you? What are the implications? Then what's the next step forward? Why is the price at this? Why are they valued at this pricing and stuff like that? So these are the kind of questions that you want to ask yourself. So lastly, we will be looking at policymakers around the world as we start to see a bit of social unrest ongoing due to the unemployment, starvation, and sanitary issues. Additionally, in the labor market, the baby boomers aren't retiring. So people of parents age 60 and above whatsoever, they aren't, either they are not ready to retire due to certain financial situation, or they just couldn't bear to retire. And there's many other reasons for also. If you are interested, I can drop you all the link to the article after this whole session. On a global level itself, due to the global warming situation, we start to see deterioration of climate condition, which is actually causing more natural disaster. And this natural disaster that is affecting the respective country will have some form of financial impact. Because since we are on investment topic, we'll just relate to financial, but obviously there is much more than just finance itself. So they do have certain kind of impact in their particular country or the states or the city or whatsoever. So in summary, if let's say, for example, you doze off for the past 15 minutes or so, what you need to understand is that every economy operates very differently. Emerging or developed economy doesn't matter, as they have different regulatory bodies and I would say different ways of managing through different kind of policies. Second will be the importance of actually business cycle. It's happening, it will happen, and it's also, I would say, a form of correction that actually takes place in the economy. Lastly will be to identify the indicators. This actually to help us make better decisions, yet at the same time, don't get too hang up over the numbers, yet numbers doesn't lie. So what we need to do is actually to learn to weigh both qualitative and quantitative aspect. So to identify which is better in terms of the different kind of scenario or circumstances. So yeah, I've actually come to the end of my sharing. My Instagram, my YouTube, and if you want to join a Telegram group whereby we share daily news that's happening around the world or financial related articles or just any form of open discussion, you all can just scan a QR code and just join the group. Then I have my reference. If not, the floor is open up to questions. Yeah. If no question, we can actually call it off for the day. Yeah. Then I'd like to actually thank you guys for the time. I'll see you guys next week.